This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.
Good Sunday morning. This is Bud Hettinger. Next on News Radio 93.1 WFLA, the longest-running radio show in Central Florida, Dollars and Cents, with my good friend Joel Garris from Nelson Financial Planning. You can call him at the office this week at 407-629-6477 to schedule your free consultation to discuss your retirement plans, or you can talk to him right now at 407-916-5400.
Well, Merry Christmas Eve of the Eve. Of course, if you're logging in and checking your balances on a regular basis these days, you may be thinking all you're going to get is coal for Christmas. And certainly it would be easy to come to that conclusion after this past week. The worst week for the markets in over 10 years. Pretty rough out there in the financial world. The Dow lost 1,655 points. Big news for sure. And a pretty tough December, pretty dramatic, particularly for the Dow, down almost 12% in the first 23 days. And if you're keeping score, there wasn't even 23 trading days, of course, because there was a bunch of Saturdays and Sundays in there. So we will have much to break down on the program today. And so welcome. Good morning. It's a little chilly out there. You're listening to Dollars and Cents. My name is Joel Garris of Nelson Financial Planning, and we're coming to you as we have for over 30 years on the airwaves on News Radio 93.1 WFLA. I haven't been on that station because they keep bouncing around on the FM dial. They keep changing the signal. But on 540 AM, that's certainly where we've been for a while. Not all 30 years, because that's also bounced around a little bit. But that's the radio biz, if you will. I will not try and figure out the radio business on today's radio show because, well, we've got the business of the market. And what in the heck is going on out there? Perhaps one of the biggest things that bugs me right now is just how happy everybody is in the media. Do you ever notice that? They get really excited. They get really jolly when they can report negative things. You ever stop and think about that? Boy, they're just in such a great mood. Eyes a twinkle, smiles all jolly, because now they actually have something that they can really scare you with. And boy, we'll talk about that on the program too, about what you get scared into. Saw another example of these index-linked and fixed annuities, these equity indexed annuities. Boy, I'll tell you, got some interesting numbers on that. Had someone come in this past week and show me a presentation piece. It's going to be interesting when we get to that topic. But before we get to that, we do really have to spend some time breaking down what's going on out there. And there's many causes. I'm reminded of an article that I printed out for the staff a couple of weeks ago on one of the days where the Dow went down quite a bit. I think it was about 800 points on that particular day. And the article was entitled, something about Dow decline 800 points. The 9 reasons why. Okay. The 9 reasons why the market went down in a single day. Let me loosely translate that article. If there are 9 reasons why the market went down, guess what? then nobody really knows why. It's really more just a shotgun approach, and you'll probably hit the reasons. Some of them, all of them, or perhaps a combination. It seemed that was sort of working against the market this past week, that combination of uncertainty. I do believe that there is one primary cause, and we'll share that with you here in just a little bit. But obviously, we can point the fingers at the government shutdown. That's a popular one. We can point the fingers at trade, right? We can, in fact, point the fingers on at investors themselves. Tremendous money leaving equity mutual funds, leaving the stock market. That can certainly be to blame as well. But perhaps where the blame primarily lays at is over concern over interest rates and debt and what the Federal Reserve is going to do. Oh, Brexit also is in there somewhere as another reason. So, we could easily come up with a top 10 list, all of which would be a shotgun approach of just skimming the headlines off the paper. But in our view, the primary issue is really what the Federal Reserve is trying to do. So let's take a moment and step back, because you hear a lot about what the Federal Reserve did, and that is in terms of raising interest rates this past week. But there's something else that they are doing, that's going on that we forget a lot about in the background. And that is this notion that post-2008, the Federal Reserve did a lot of this thing called quantitative easing. Hopefully you remember that term from a few years back. And so what they were doing with this quantitative easing, because they had brought interest rates down to the point where they couldn't really kind of bring them any lower. So instead what they did, they were doing this technique called quantitative easing, where they're going into the market, the bond market, and they're buying up treasuries, United States treasuries, in an effort to help continue to push the price up and keep the interest rates low. Okay, so they did that. And then 2 or 3 years ago, they announced, okay, well, we don't have to do that. We're going to stop doing that. And then they started on this interest rate increase as sort of the next step. But what is happening in the background is that all of those assets, all of those treasury securities that the Federal Reserve bought, those are now getting rolled off of the balance sheet to the tune of somewhere around $50 billion a month. Okay? So now not only do you have the Federal Reserve raising rates, but they are effectively engaging in a quantitative tightening policy as well, which is what they've been doing for the past couple of years as those assets are sort of rolling off. But when you stop and think about $50 billion a month, well, that's a little bit more than pocket change. And so consequently, you really do have a double action, if you will, that's occurring from the Federal Reserve. And what the markets are clearly saying on that is, whoa, slow down, wait a minute. That is now getting to the point where it is too much. And as opposed to the quantitative easing, which is supposed to help lower mortgage rates and costs and increase stock prices and spur spending, okay, the Federal Reserve has sort of forgotten that if quantitative easing is supposed to accomplish that, well, then doesn't quantitative tightening accomplish the opposite effect? And what's happened is the Federal Reserve is sort of forgetting that piece of the equation, and they're kind of just focusing on this interest rate thing, but they're forgetting that effectively they've got a quantitative tightening happening at the same time, and that's what's causing the market fits, because here we are in a situation where you've got now higher interest rates, and they seem to just be blindly increasing these interest rates every quarter, although they have tempered their view, and we'll talk about that a little bit more in the next section as to the view getting a little tempered of late. But the Federal Reserve is really forgetting the impact that effectively quantitative tightening, $50 billion a month, I mean, that's a lot, is happening. And the concern that brings to the market is that you could very well have the Federal Reserve in a position where it is effectively sort of killing the goose, if you will, and not for Christmas dinner. It's for the overall economy, and so I think the market is clearly pricing in that worst case scenario. And then, of course, you have all the other stuff, in the background with Brexit and the trade and the government shutdown and those kinds of things that are floating around in the background that only sort of exacerbate the news story along the way. So I think the Federal Reserve really needs to kind of wake up and sort of smell the Christmas coffee and ultimately understand that their quantitative tightening simultaneously with interest rate increases when the rest of the world, and this is really a rest of the world story, because if you look at the economic data and you look at the statistics here, in this country, we've got record low unemployment. GDP growth for this year is going to come in at 3.3%. We've got relatively mild inflation. I mean, that's kind of the perfect mix for your porridge, if you will. And so it kind of makes you wonder whether the Federal Reserve is really doing what it needs to be doing at the right time. Because when you look out at the rest of the world is not experiencing that level of economic growth by any stretch of the imagination, and they are still trying to work through their own recovery, particularly on the interest rate side of things. If you look at Germany, for example, your German treasury, if you will, is at 0.5%. Your Bank of Japan, your Japanese treasury, is at 0.1%. Meanwhile, we're hanging out at 2.5%. You see the point? It might be leaning out a little bit too far forward on our skis on this, particularly because when you look at the rest of the world's economy and you look at it relative to ours, there's a much greater risk that the misperformance of other economies around the world may very well serve to drag ours down. And so you don't need to worry about raising interest rates or quantitative tightening, for that matter, because that's sort of going to happen naturally. But that's the take on the Federal Reserve. The piece that's not getting talked about, the piece that's not getting discussed much is this other piece that's happening besides the interest rates. It's the flip of the quantitative easing that they were doing for many years, and that's rolling off the assets that they purchased during the quantitative easing period to effectively be a quantitative tightening period. They seem to be forgetting that piece of the equation when it comes to helping to dampen down inflation. We'll talk more about all of this, of course, on the program, along with what you should be doing. We will recap. We gave you some thoughts, I think, last week or maybe the week before. We will share those thoughts again with you as opportunities to look at your portfolio and adjust accordingly. So we'll be back here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA.
this is Bud Hettinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Yes, indeed. Welcome back to the program, ladies and gentlemen. Hard to believe, December 23rd, Christmas in a couple of days. If you're looking at the calendar, it's kind of an odd year with Christmas falling on Tuesday, and then correspondingly, that means that January the 1st also falls on Tuesday. So markets are open tomorrow for a short period of time until 1, and then they are open Wednesday, Thursday, Friday, and then they do not effectively close out the year until Monday of next week, because Monday of next week would be December 31st. So intermixed all of the holidays and the partial market days, you know, you've got kind of these odd days, which for many in the financial world, you will find that there aren't a lot of people around this week, and certainly next week, particularly the first part of that week, with the first being the holiday. We are the office is very much open during all of those days, but there is there's definitely obviously around the holidays a period of time where there is a much less people doing what they're doing, particularly in the financial industry and in probably most industries for that matter, with the exception, obviously, of retail. But the words of caution this week, much as they would be the words of caution that we would say at any point, but particularly this week, be careful on the market swings this coming week, because they're going to be pretty light on trading volume. So you could really have a situation where the market starts to accelerate, by the way, in either direction, okay? Because volatility, remember, has both sides of the equation, both up and down. Oftentimes we only hear about the down, but there is, in fact, very much an up equation to volatility, which could factor either way. Unfortunately, I think sentiment is a little on the negative side, so I would not get too focused on your market moves this week, because they're going to be pretty thin. Take a breath, get some eggnog, and don't check your account balances every minute of the day, because that's only going to give you a hangover for Christmas. The market this week, with the absence of people, the absence of traders, you're going to see, I think, a heightened level of volatility in the market this coming week, simply because of how the calendar falls, the fact that most people are on vacation, particularly in the financial industry, and you've just got an odd week in terms of how the calendar falls, with both holidays being on Tuesday. So you got like a half a work day, a holiday, 3 work days, a weekend, a work day, a holiday, and then 3 work days, and then a weekend. That's the sequence. That is a sequence that lends itself to people being gone on vacation, which means that you could very much have the computers and the programming and all that kind of stuff driving a lot of the market this week. So just words of caution over the course of the next week or two, be simply looking at the calendar. Don't get too hung up on that. And remember, the market can swing very quickly one way or the other. You did not save your entire life for the last week of 2018, the first week of 2019. You're not going to use all your money within a 2-week period of time, right? You're going to use your money over the course of the rest of your life, which means maintain that perspective. You put the money in over a course of 30-odd years. You're going to be using that money over the course of 30-odd years. Don't get too hung up on what's happening at any given point in time. Those words of caution, I think, are going to be particularly relevant over the next couple of weeks, given sentiment and given the fact that it doesn't look like any of this stuff's going to get resolved anytime soon, right? I mean, Brexit and government shutdown and all of that is very much weighing, and the Federal Reserve interest rates conversation is very much weighing on people's minds. So just a side note, some words of caution. Remember, though, you're not investing for a 2-week period of time. You're not. You save the money over the course of your lifetime. You're going to use it over the course of the rest of your lifetime. All those years of working, and if you're still working, keep saving, keep putting it away. Those years in retirement, if you're retired, you're going to be using that over the course of the rest of your retirement. Which, good Lord willing, if you're retiring at 65 or 70, check your life expectancy calendar. If you don't have one, the IRS does. They're going to tell you that they think you're going to live for another 20 or 25 years. IRS usually has a tendency to be right. So just be careful out there. It might get a little bit more fixation by the financial media on those headlines. Anyway, Federal Reserve has certainly changed its tone very, very soon. The silver lining is that the Federal Reserve does recognize that it is in a tenuous situation. I don't think they quite appreciate all of the impact of their quantitative tightening plus their increased interest rates are, but they are starting to kind of soften the tone. Jerome Powell, who's the head of the Federal Reserve, in October of this year, is quoted as saying rates are still accommodative. We may get past neutral, but we are a long way from neutral, probably. A month later, or beginning of this month, he's sort of changed that, said rates remain just below the broad range of estimates of the level that would be neutral for the economy. So you see where we've gone a long way from neutral to we're at neutral, just how quickly that can change within 30 days. So the Fed needs to be very much on its toes here because I do think that they are in a tenuous position. Robert Kaplan, who's a member of the Federal Reserve, same time period, end of October. My base case for 2019 raised the funds rate into a range of 2.5 to 2.75, or more likely into a range of 2.75 to 3%. And then here in this month, you're going to hear me counsel to be more cautious and patient. I'm seeing a high level of uncertainty as a factor in my thinking. Well, yeah, no kidding. You better get it into your thinking because the Federal Reserve is running the risk of killing the Christmas goose, so to speak. And so more on that, obviously, in the weeks and months ahead. But that is the primary issue working out there today. And that is where the focus has got to be because they do really have the gas and the brake when it comes to the economy. And the fear is, and clearly the market is sending this message, is that perhaps they've jammed the brake on too much with the combination of interest rate increases and this thing that you don't hear much about. You used to hear a lot about quantitative easing, but you don't hear the flip side of that, which is what they're engaging in to the tune of $50 billion a month, which is selling off the assets that they acquired during the quantitative easing period of time. That effectively works out to be a quantitative tightening type of policy. So when we get back from the break, we will continue the conversation, give you some things to be thinking about. We sort of hit upon that in this segment as well. Be very careful over the next couple of weeks. It's holiday season. There's not much volume in the markets typically during holiday season. Any moves can get exacerbated pretty quickly in the market. So be careful on getting too hung up on that perception. We'll have some other ideas as well for how you can kind of weather through this stuff and enjoy the holidays without getting too hung up on the headlines. Here on Dollars and Cents, this is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.
This is Bud Hedinger. You know, you can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on News Radio 93.1 WFLA. Also simulcasting over there on the AM dial at 540 AM. Talking, of course, as you would expect us to be talking, about what's been going on this past week in the markets. Pretty tough week, worst week in a decade. How's that for coal in your Christmas stocking, huh? And as we've been talking about on the program, the biggest cause of all of that is really the Federal Reserve and trying to unwind all of that highly accommodative monetary policy that was in place for many years. The problem is that there's two pieces that are now going on. There's the piece you hear about, which is increasing interest rates, which is what the Federal Reserve did this past week. But also simultaneously, it's unwinding all of the quantitative easing that it did, effectively putting a quantitative tightening perspective on things to the tune of about $50 billion a month. That's not pocket change, that's real dollars. And the combination of that, clearly the market is saying that combination is too much and runs a high risk of killing the Christmas goose, if you will, with that approach by the Federal Reserve. And so consequently, that's getting a tremendous amount of attention and a tremendous amount of reaction in the markets. So what can you do as an investor? Well, this is a bit of a tongue-in-cheek type of advice, but there is a high degree of truth to the first piece of advice that we are going to give you. Enjoy the holidays. Appreciate what they are. A time of family, friends, celebration. Remember the real reason for the season. Don't log in to your account every minute of every day. Turn off the TV, hide the remote. And folks, that last one, it may surprise you, but I don't watch any TV. I really don't. It really is nothing but a distraction from us being able to provide our listeners every Sunday morning and our clients in the office Monday through Friday some degree of perspective. Because in the 10-second soundbite world we live in, it's not there, folks. And I just refuse to get sucked in to misinformation and partial facts. So when I want to brush up on what's happening in the economy, which these days is pretty much every other day, I'll be reading stuff. 20-page reports from here, 10-page reports from there. I'm going to be reading my information. I'm not going to be listening to CNBC or Fox or any. I don't listen to any of it. It's chaos. It's nonsense. It's gobbledygook. It will only serve as a distraction from your long-term investment results. Hide the remote. Enjoy the season. Take a deep breath. This is money that you've saved over the course of your lifetime or are saving over the course of your working lifetime. And at the end of the day, you are going to be using it over the course of your lifetime. Now, we do have some very specific, concrete suggestions for you to be thinking about. We shared them a couple weeks ago. We're going to continue. We're going to recap some of them. First and foremost of all, it is incredibly important to be diversified and to be balanced. Interesting little statistic I stumbled upon just this past week. The least popular 100 companies in the S&P 500 at the beginning of this year, meaning least popular, meaning the ones that were not really followed or were not rated highly by analysts on Wall Street, that least popular group has the best possible return so far this year. Meanwhile, the most popular 100 company is the S&P 500, as measured by analyst buy ratings, has the worst performance. So what's the conclusion there? The conclusion is to make sure you're diversified. Because if you go back to 2017, the 100 most popular stocks had the best return for that calendar year, and the 100 worst stocks had the worst return. Point being, in sharing you that statistic, make sure that you are diversified. That's certainly a concrete suggestion we can give you. And we break that down more of the growth versus value. We talked a little bit about this past a couple of weeks ago, or maybe it was just this past week. Make sure that you've got some balance between growth and value, because a lot of what's been driving this market is more those growth companies, Amazon, Google, Facebook, those types of companies. Those also are the types of the companies that are getting hit harder in this decline. So make sure you've got a balance between value and growth. And then also be careful about trying to get out of your international stuff. There is tremendous value outside the U.S., as many economies outside the U.S. are experiencing much harder periods of time. We will slide to the phones. We've got Olin on the line from Palm Bay. Hey, Olin, good morning. How are you?
Hey, good morning to you, and Merry Christmas, Joel.
And Merry Christmas as well, and a Happy New Year. Hopefully the Bulls return in 2019, that's for sure.
I hope so. I've really been pounded this last, I guess, month and a half or 2 months.
That's right.
And, I have an online brokerage account that I manage, and I've really been pounded. But the only thing that gives me comfort is that the market has always recovered, always rebounded, all the way from 1929 when it crashed to any other bad times like 2007, 2009 when things were really rough. But the market always comes back, and I think you need to be in stocks or mutual funds or whatever that you've done your homework on and you're satisfied with them. Stay with them, I guess, is what I'm saying.
Oh, and I couldn't have said it better myself. That is perfect. Yeah, I love that statement, because you're exactly right. You stop and think about it. There's never been a market decline from which the market has not just fully recovered, but gone on to set higher highs. That's pretty powerful. And it's getting lost right now out there. I'll tell you, okay, the only people that are joyful are the idiots on CNBC and all the other business stations out there, and the mainstream media for that matter too. They love it when they've got bad news to talk about.
Yeah, I watch that sometimes, but I mute. I put it on mute because I like to watch the ticker thing across the bottom. And I think those people on CNBC, they're talking to themselves. They're not talking to me, Olin, because I don't know what they're saying. When they talk about an inverted yield curve, boy, my head starts hurting. But they are BSing amongst themselves, and I guess sometimes they might have some good information, a little tidbits, but it's mostly little 15 or 20 second sound bites, and it's just their club. That's just my opinion on it.
I would agree with that. I tried to tackle that inverted yield curve conversation a couple of weeks back, and boy, yeah, that is a mind-numbing exercise. But what they've done is they have converted over to an ESPN-like type of approach, and investing is not a sport. Those people on those channels, Olin, they do not help real people manage real money. That's not their job. And it's fascinating that you've got so many folks that listen to them and react to them when that's not really even the business or the expertise that they have. It really is more entertainment, if you will, that is their business.
Yeah, that's just like you said. It's like ESPN. That's a perfect description of it to me. And then people listen to them and then maybe do the wrong thing. But I'm 77 years old, so anyone that's just retired or in their 50s or 60s, they have time on their side anyway as far as these market downturns and things, and they should just stay the course,
Absolutely. Couldn't have said it better myself. Thanks for the call, Olin. You have a great Christmas, okay?
And you as well, Joel.
Very good, sir. And hey, if y'all don't believe me, you all don't want to listen to me, okay, just listen to Olin. He's right on the money, okay? With that, we will slide to the break. We'll open up the email bag as well. Not too late to shoot us an email during the break here. The email address, which we had not given out early in the program, I was derelict on that duty. It's Joel, my first name, Joel, at NelsonFinancialPlanning.com. Those are the numbers to call on in and be a part of the program. We'll open up the email bag when we get back here on Dollars and Cents here on News Radio 93.1 WFLA.
This is Bud Hedinger. You can talk to Joel Garris of Nelson Financial Planning right now on Dollars and Cents about anything to do with your money by calling 407-916-5400. Give him a call. It's time to make sense of your dollars.
Hey, welcome back to the program, ladies and gentlemen. Dollars and Cents here on 540 AM News Radio 93.1 WFLA. Was thinking about that call from Olin during the break. Said it pretty well. Pretty accurate perspective, for sure. Really, there's just a lot of folks getting distracted. The numbers that are flowing out of the equity side are just staggering, and the studies are so real when they look at investor returns versus market returns, and getting a third of the return that you should be over an extended period of time is no way to retire, folks. But many wind up in that predicament simply because of reacting to headlines like today, which is why we give the words of caution, particularly as we look at the calendar over the next 2 weeks. Very light volume is expected in the market simply because many people are on vacation. And so that means that any move is going to get exacerbated. So be careful on that. Pay attention. Enjoy the holidays. Pay more attention to the holidays than that, because the reality is it will, in fact, pass, particularly when it gets so far oversold in the other direction. What can you do? Well, make sure that you've got a good balance and be diversified. Lose the remote. That's probably my best suggestion. But remember the difference between value or dividend-paying companies, which have a tendency to be a bit more defensive, versus growth companies like the Amazons, the Netflix, the Googles. Those have been really driving the market. They're also really driving the decline as well. And be careful about throwing out the international stuff as well, because much of that is is trading at a pretty good value. If you look at the valuations of some of these large companies headquartered outside the U.S., particularly relative to their stock prices versus their earnings. We'll slide to the email bag. So Frank sends us an email early. This is actually going to be a topic for next week and, frankly, even the following week, because as the calendar falls, the year market-wise does not end until Monday after next week. So it'll, of course, as we do each and every year, we will have our fearless forecast. And Frank's email is asking us about that. The great Joel Karnak may be wrong. How did the market loss affect your 2017 prediction of 2008? This is the real question today. Yes, it is. Although I remain an optimist, there's still some days left in the year that perhaps will get me a little bit closer to where I was thinking the year might go. I was on target 3 months ago, if that counts for anything. But unfortunately, not so much on target now. The funny thing is I got a Christmas card from Leanne and Rick a week ago. That very nice card, by the way, handmade. That very nice. You don't see many of these very often. So I kept it. And they're recapping the predictions for the end of 2018. Joel came in at 27,300, I think was the number. At least that's what it says in the card. We'll have to double check our records on that as well. To Leanne and Rick, to their credit, predicted a much higher level, 29,000 and then 30,000. Boy, I wish that had been the case. And so clearly this decline has trimmed back what our prediction would be. Clearly the market is reacting to what's going on with the Federal Reserve. I think in the beginning of the year, we were a bit optimistic that the Federal Reserve might not quite get too far down the path in terms of raising interest rates. On the other hand, it certainly seems like they are sort of losing sight of that and having to backtrack very rapidly over the course of the past 30 to 60 days, as witnessed by some of those comments and those quotes that we shared with you earlier in the program. So we will talk much about that, combined with the fact that I've got to go on record for a fearless forecast as well. We'll probably do that next week, although technically it's not the end of it is not the end of the year because there would be one more trading day the Monday after that. But we will do that. And then we did not get to this, but I want to get to this next week, so we will do that. Some of the things that people are doing that don't make any sense with their money today. And we'll talk specifically about the equity index annuity stuff. Wanted to get to that today, simply ran out of time. We'll hit that next week on the program. So stay tuned for that and have a Merry Christmas. Have a Merry Christmas. Remember the reason for the season and enjoy family, friends, and the celebration of the birth of Jesus. You've been listening to Dollars and Cents. This is 540 AM News Radio 93.1 WFLA. Joel Garris, Nelson Financial Planning.
This is Bud Hettinger, and you've been listening to Dollars and Cents with Joel Garris of Nelson Financial Planning. If you missed any part of today's show or want to listen to it again, check out the radio show at www.nelsonfinancialplanning.com or connect with them on Facebook or Twitter. Be sure to call Joel this week at 407-629-6477 to schedule your free consultation to discuss your retirement plan.
Fees, commissions, expenses, investment costs come in all shapes and sizes. Do you know how much your investments are really costing you? At Nelson Financial Planning, we believe that costs should be a major consideration in your financial plan. After all, the lower your costs are, the more you get to keep for yourself. This is Joel Garris, and I invite you to get educated about your investment costs. Visit NelsonFinancialPlanning.com or call us today at 407-629-6477 to set up a personal conversation to review your investment costs. That's NelsonFinancialPlanning.com or 407-629-6477 to set up that conversation.
A-plus Better Business Bureau accredited. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services. Member SIPC and FINRA. Listen to Joel Garris on Dollars and Cents every Sunday at 9 a.m. on News Radio 93.1 WFLA. This show is intended for general purposes only, as individual situations may vary. Statements made should not be relied upon as recommendations or solicitation. When discussed, past performance is no guarantee or indication of future results. Nelson Financial Planning offers securities through Nelson Ivest Brokerage Services, member FINRA, and SIPC.